Hello and welcome to Stocks Telegraph. In this video, we will guide you through the process of investing in two of the most popular stock market indices globally, the S&P 500 and the Dow Jones Industrial Average. These indices are considered significant benchmarks of the US stock market's overall performance, and serve as an indicator of the economy's health. By investing in these indices, you can gain exposure to a diverse range of stocks from various industries, helping you mitigate risks associated with individual stocks' volatility. Whether you're a beginner or an experienced investor, investing in indices is an excellent way to start building a diversified portfolio. So without further ado, let's dive in and explore how to invest in the S&P 500 and the Dow Jones Industrial Average. Before we dive into investing in the S&P 500 and Dow Jones Industrial Average, it's important to understand what stock market indices are and how they work. A stock market index is a collection of stocks that are selected and weighted, based on specific criteria to represent a particular segment of the stock market. They provide a way to measure the overall performance of the stock market, and can serve as a benchmark for investors to compare their own investment returns against. Stock market indices are generally designed to reflect the performance of a specific market or sector, such as large cap stocks or technology companies. They are often used as a barometer of the economy's health, with investors and analysts closely monitoring changes in the index's value, as an indicator of broader market trends. To be included in an index, a stock must meet certain criteria set by the index provider, such as market capitalization, liquidity, and sector classification. The stocks that are included in an index are typically reviewed and rebalanced periodically, to ensure that they continue to meet the index's criteria and accurately reflect the market segment they represent. Overall, stock market indices provide a useful tool for investors to track the performance of the stock market, and gain exposure to a particular market or sector, without having to individually select and invest in each individual stock. Moving on to the first index, the S&P 500 is a market cap-weighted index that comprises the top 500 publicly traded companies in the United States. The companies included in the index are selected based on their market capitalization, which is calculated by multiplying the company's share price by its total number of outstanding shares. This means that larger companies have a greater impact on the index's overall performance than smaller companies. The S&P 500 index is widely regarded as a gauge of the health of the US stock market, and is used as a benchmark by many investors. The companies included in the index span across a variety of sectors, including technology, healthcare, finance, and consumer goods. This diversification can help mitigate the risks associated with investing in individual companies. Investors can gain exposure to the S&P 500 index through various investment vehicles, such as exchange-traded funds and mutual funds. These funds track the performance of the index, by investing in the underlying stocks that make up the index. Some of the most popular S&P 500 index funds include the SPDR S&P 500 ETF, and the Vanguard 500 Index Fund. Investing in the S&P 500 is easy, and the simplest way is to invest in an index fund, or an exchange-traded fund that tracks the S&P 500. These funds are designed to replicate the performance of the index, by holding the same stocks in the same proportion as the index. By investing in these funds, you can get exposure to a diversified portfolio of stocks with a single investment, and the fund's performance will closely mirror the performance of the S&P 500. These funds are typically low cost and provide investors with a convenient way to gain exposure to the US stock market. To invest in an S&P 500 index fund or ETF, you'll need to open an investment account with a brokerage firm or a robo-advisor that offers access to these types of funds. Moving on to the Dow Jones Industrial Average or the Dow, this index tracks 30 large blue-chip companies that are considered industry leaders. These companies are chosen by the editors of the Wall Street Journal based on their reputation, size, and market influence. The Dow is different from the S&P 500, in terms of the number of companies it tracks and the way it is calculated. The Dow is a price-weighted index, meaning that companies with higher stock prices have a greater impact on the index's performance. As a result, the Dow's performance may not accurately reflect the performance of the broader market. If you're interested in investing in the Dow, one of the most convenient ways is to invest in an index fund or ETF that tracks the Dow. By investing in such a fund, you can gain exposure to the 30 blue-chip companies that make up the index with a single investment. These funds are designed to replicate the performance of the Dow, by holding the same stocks in the same proportion as the index. This means that your returns will closely match the performance of the Dow, minus any fees and expenses associated with the fund. Furthermore, since the Dow is composed of large, established companies with solid reputations, investing in a fund that tracks this index can be a relatively safe and stable investment option. So there you have it, how to invest in the S&P 500 and the Dow Jones Industrial Average. Investing in the S&P 500 and Dow Jones Industrial Average is an effective way to diversify your portfolio, and track the overall performance of the stock market. It provides a low-cost and efficient way for investors to get exposure to a diversified range of stocks in different industries. However, it is essential to conduct your own research, and consult with a financial advisor before making any investment decisions. Remember that investing always comes with risks, and it's crucial to have a long-term perspective. By holding on to your investments and staying the course, you can potentially benefit from the growth of the market over time. Thank you for tuning into this informative video on how to invest in the S&P 500 and Dow Jones Industrial Average. We hope you found the insights and tips useful. If you'd like to learn more about investing and stay up to date on the latest financial news, be sure to check out our website at stockstelegraph.com. Don't forget to subscribe to our channel for more helpful investing tips and insights, and hit the notification bell so you never miss an update. As always, we encourage you to do your own research and consult with a financial advisor before making any investment decisions. Thank you again for watching, and we'll see you in the next video.